In 1929, the American economy appeared to be at its absolute peak. With unemployment at just 3.2%, President Herbert Hoover publicly declared that the nation was closer to the final triumph over poverty than ever before in history. Yet, just months later, that prosperity vanished. 12 million Americans were suddenly out of work, and as thousands of banks failed, the savings of an entire generation evaporated. How did a seemingly invincible economy shatter virtually overnight? The Roaring Twenties were built on a mirage. For an entire decade, national growth was fueled not by real income, but by a dangerous, invisible web of borrowed money. The seeds of the crash were sown at the end of World War I. 4 million American troops returned home to a civilian economy that initially struggled to absorb them, leading to a brief post-war recession. To stimulate the recovery, the government aggressively lowered interest rates, making it cheap and easy for banks to lend money to businesses and citizens. Simultaneously, the moving assembly line revolutionized manufacturing. Henry Ford's workers could now build a Model T in 90 minutes instead of 12 hours, leading to a massive surge in cheap, mass-produced civilian goods. The boom was sustained by a new financial innovation, installment plans. Working-class families could now buy now and pay later, taking possession of expensive items for only a small fraction of the cost up front. This credit system quickly spread to every corner of the home. By mid-decade, 3/4 of all major household purchases, including washing machines, vacuums, and the radios in every living room, were bought with loans. Americans shifted away from building tangible savings, choosing instead to live comfortably on a foundation of borrowed future wealth. By the middle of the decade, the practice of living on credit moved from retail goods into the heart of the financial system, the stock market. Investors began buying on margin. A monkey puts down $10, borrowing $90 from a bank to control a $100 share. As this strategy spread, national debt exploded to the equivalent of $2 trillion today, a fragile tower of wealth built on paper. In 1926, a massive hurricane leveled the coast of Miami, instantly destroying the value of Florida's real estate market and the borrowed wealth tied to it. Instead of viewing the Florida collapse as a lesson in risk, the public doubled down. To recover their losses, thousands of investors redirected their remaining borrowed capital back into the rising stock market. The fear of missing out on a rising market had overridden financial logic, and the nation was now collectively setting a trap for itself. By 1928, the government finally recognized the danger and raised interest rates to discourage further borrowing. The policy was ignored. Speculative mania was so high that the market surged another 40% in a single year, reaching a peak that many believed would last forever. A slight dip in market prices suddenly triggered a massive, uncontrollable chain reaction of panic selling on Black Thursday. In just 1 week, over 30 million shares were dumped. The collapse wiped out $30 billion, nearly half of the nation's entire wealth. The collective psychological spell of infinite economic growth finally broke, rendering the underlying value of these corporations completely irrelevant. The shockwaves quickly moved from the stock exchange to the physical economy of Main Street. Because ordinary banks had gambled citizen deposits in the market, thousands of them failed. This immediately cut off the loans that factories and stores needed to pay their workers and stay open. As businesses shuttered, wages were slashed and millions fired, pushing unemployment to an unprecedented 25%. Middle-class families who once owned the latest technologies were forced into massive shantytowns that began appearing on the edges of major cities. The crisis turned into a global contagion. Desperate U.S. banks pulled their remaining capital out of European institutions, causing them to collapse and dragging the rest of the world into a terminal downward spiral. The Great Depression represents the moment that an entire society's wealth finally became untethered from actual, tangible value. When an entire economic system is built purely on speculative debt, a devastating crash isn't an anomaly. It is a guarantee.